Welcome to this video. In the previous video, you learnt about some basics of the Forex markets and their notations. In this video, you will learn about the major macroeconomic factors that affect the Forex markets, various players in the Forex markets, and how technical factors influence the Forex trading. The Forex markets are heavily influenced by scheduled and unscheduled events. Scheduled events are those events whose event timing is announced beforehand. For example, a central bank's interest rate decision, an election outcome, etc. Conversely, an unscheduled event is one which is not expected to happen or whose timing is unknown. A declaration of war, or a tweet from a political leader, etc. These unscheduled events are rare, but they increase the volatility of the market, as the market participants try to factor in the sudden development. Let us look at some of the scheduled macroeconomic events that affect the Forex market. When the central bank of a particular country increases its interest rates, it benefits the investors who withhold that currency, as they get paid more interest. As a result, the higher interest attracts investors chasing higher yields, and the demand for the currency increases. The interest rate decisions are the most important events in the calendar of a Forex trader. Unemployment data. Every month, the unemployment data of most countries is published by their governmental agencies. If this data is better than expected, then the currency of that country gains in value compared to others, as the decrease in unemployment would mean an increase in workforce, which will directly translate to demand in the short-term interest rates, and this results in the strengthening of the currency. 3. Consumer Price Index, CPI. This is an indicator used to gauge the inflation in the economy. If the inflation is high, then it would mean that there is more money in supply than is needed. This drives the value of the currency down, then the central bank would step in to reduce this supply. In order to do this, most central banks resort to increasing the interest rates, which would again appreciate that currency relative to other currencies. But this relationship between the currency and the inflation is largely dependent on the inflation anchor, or the central bank's ability to rein in the inflation. To summarize, the interest rates are directly proportional to the value of the currency, and the unemployment and CPI are inversely proportional to the value of the currency. Apart from these main events, there are many scheduled press releases by the leaders of states and central banks that move the markets. When scheduled or unscheduled events take place, many traders rush into the market to reduce their exposure. Now let us look at a few of these participants in a Forex market. Governments and central banks. Governments or central banks intervene in the currency market to stabilize their currency. Commercial banks. Banks often have corporate clients in various countries or have their own branches operating in various countries. This means that they have to manage their exposure to many countries from time to time, so they are actively involved in trading the currency markets to hedge their risk, or mostly play the part of a market maker. Financial institutions. Other financial institutions such as investment banks and pension funds also trade actively in the currency market. They do so on behalf of their client, to take speculative positions, or to hedge their risks. Currency speculators. Speculators mostly trade on their own, and they can be individual traders, dealers or brokers, whose main purpose is to generate profit by trading the currency market using various trading techniques. We will discuss some of these later. Now, let us look at a technical factor that influences the Forex trading. Range trading. This is one of the most widely used techniques in the Forex markets. Most of the governments and central banks prefer their currencies to be in a fixed range, as this would help the economic stability of the country and the businesses within it. Any sharp devaluation in a currency is usually followed by the market intervention of the central banks to stabilize the Forex markets. Such interventions from the past help traders develop the support and resistance price levels, where they expect the governments to intervene. So the traders take contrary positions whenever the markets break these levels. Our discussion on the basics of Forex markets ends here. In the next video, we will look at the momentum strategy and backtesting on Quantra Blueshift.